We are watching shares of IBM this morning. The stock sharply lower in pre-market trading, even after the company's earnings beat the street's estimates. But IBM's gross profit margins missed expectations. Doug Flynn, certified financial planner and co-founder of Flynn Capital Management, and Joseph Soroka at Nova Point Capital joining us now. Welcome to both of you. Joseph, I'll start with you. What went wrong here? You think you beat your earnings forecast. Somebody should buy your stock, right? What happened?
Well, with IBM, the margin contraction continues to be an issue weighing on the stock. The company's trying to move away from the legacy businesses and hardware and consulting and get into the more profitable data and cloud business. But it just seems quarter after quarter that as much as the new businesses are accelerating, they're not moving the needle relative to the legacy businesses.
And Doug, when you look at these earnings, drill down into them, what you find is that a lot of the benefit, a lot of the improvement in earnings was really a tax gain, a tax benefit. So people didn't like that. You got to think now, Gina Ramady, the CEO there, been there a long time. This has been a very slow turnaround, as Joseph just said. What happens next? Can this stock find a way to come back?
I think it begins to, and the reason is because you've had double-digit declines in revenue, and that's mitigated. They're actually probably going to show revenue growth, maybe positive for the first time in a while, and that's as they keep moving into the other things like cloud and the other areas, which all the investors want them to do. It's just not happening fast enough, and that's the problem for most people and why they're really losing patience. But I think these are opportunities here. The outlook is good if they can continue to keep making those moves somewhere in here. It has a healthy dividend, and those are some good signs.
You know, let's turn to the banking sector for a second here. You would think this would be great days for the banking sector. We've had 7 rate hikes since 2015. The bank stock's getting a $2.5 billion windfall from these improved taxes. Great news for them. They even like the volatility in the markets. That's good for them, too. Joseph, to you, what kinds of improvements do you expect to see generally? We've already had several of these stocks come out. And specifically, what do you see for Morgan Stanley today, which is reporting?
Well, I think Morgan Stanley should do well, certainly on their wealth management side. That's a good, strong, steady piece of the business. And trading and investment banking should be fine as well. The greater issue with the banks is we see this sell the news fall off like we saw in JP Morgan, Bank of America, Goldman Sachs. And really the flattening yield curve in the lending business is really the most concerning part about banks right now.
Yeah, so just to drill down into that a little bit, Doug, you look at JP Morgan Chase, they were first out of the gate. People decided in the end, even though their EPS was higher, they didn't like what was going on in the loan business. Goldman Sachs got hit on buyback breaks, buyback share breaks. They had planned to buy back more shares and said, no way. Doug, is this a case where a sector, you know, Wall Street's basically already said, we know you're going to do well, we want more?
I think so. I think they do want more, and I think you'll get more as interest rates go up. All of these banks have the opportunity to make more money. They actually make more money when rates do go up. So that's a lending positive for them. Obviously, you've got some issues with their lending portfolio and some other areas there. There's always issues. There's always going to be things to focus on that are negative. But generally, as the employment improves, the economy improves, earnings are improving, they're not going to be sitting on the side and not participating in that. You know, interestingly, we've 35 quarters in a row of earnings beating expectations.
We love that.
In the market, and there's no reason why we can't think 36 is going to happen with this season.
And Joe, quickly, I'm starting to think, we had expectations of S&P 500 EPS gains of 16 to 18%, 23% for tech stocks. But will the impact of these tax cuts ultimately be short-lived because they're already baked into the pie? Investors already expect them.
Yeah, they're certainly baked in, and at least half of the EPS increase in the S&P is coming as a tailwind from the tax cuts. So while we're seeing double-digit earnings growth for 2018, we think we're going to see single-digit stock market gains.
All right. Doug and Joseph, thank you so much for your time.
Anytime.
Thank you.